What if the largest financial institution in your life, the one you're forced to pay into every single paycheck, is a mathematical fraud? Most Americans think Social Security is a savings account, a personal lockbox where the government keeps your money safe until you retire. That's the propaganda. This is the ledger. In 1940, there were 159 workers paying into the system for every single retiree taking money out. Today, 2.7. That's not a political opinion. It's not left or right. It's arithmetic. 3 Nobel Prize-winning economists, spanning the entire political spectrum, have called this system what it is: a Ponzi scheme. In the next 20 minutes, we're going to show you exactly how the heist works, who gets paid, who gets the bill, and why the math guarantees it will collapse, with or without reform. We're not looking at the propaganda, we're looking at the ledger. To understand how we got here, and why 3 Nobel economists agree this is a Ponzi scheme, we need to go back to 1935, to a promise and a lie.
The year is 1935. America is on its knees. 1 in 4 workers is unemployed. Banks have failed by the thousands. The elderly are dying in poverty, literally starving in the streets. Enter Franklin Delano Roosevelt with a promise. We have tried to frame a law which will give some measure of protection to the average citizen against poverty-ridden old age. Some measure of protection, not a golden parachute, not a retirement plan, a safety net. That was the sales pitch. But here's what FDR said privately about why he structured it as a payroll tax instead of funding it from general revenue. With those taxes in there, no damn politician can ever scrap my Social Security program. Let that sink in. It wasn't designed to be a good retirement system. It was designed to be politically impossible to kill. And here's a detail that should make you suspicious. The words pension, annuity, and insurance appear nowhere in the original Social Security Act. Why? Because the drafters knew a compulsory government pension might be ruled unconstitutional, so they called it something else. They made it a tax. And Americans have been confused about what it actually is ever since. But the very first person to ever cash a Social Security check exposed the fatal flaw from day one. Meet Ida Mae Fuller of Ludlow, Vermont. On January 31, 1940, she became the first American to receive a monthly Social Security benefit check. Check number 00-000-001. Amount, $22.54. Now here's where the math gets interesting. Ida worked for 3 years after Social Security began. She paid exactly $24.75 in payroll taxes. Total contributions, $24.75. She lived to 100 years old. Her total lifetime benefits? $22,888.92. That's a 924 times return on her money. 924 times. Now, where did that money come from? It wasn't sitting in an account with her name on it. There was no investment growing over time. That money was taken, in real time, from the paychecks of younger workers. This is the foundational principle of a Ponzi scheme, paying early investors with money from new investors. And it worked from check number 1. Here's the irony. Ida Mae Fuller was a lifelong Republican who didn't even vote for FDR. And by 1970, even she understood the problem. It's been raised as far as it ought to go. Every time they raise it, they raise the amount taken away from the working people. It's just getting to be too much of a burden. The first recipient, the biggest winner, and even she could see the math breaking. But surely you have a legal right to your Social Security benefits, right? You paid in. It's your money. In 1960, the Supreme Court answered that question. A man named Ephraim Nestor had paid into Social Security for 19 years. Then he was deported. He sued to keep his benefits. The case went all the way to the Supreme Court. The court ruled against him, and the language they used should terrify every American.
The non-contractual interest of an employee cannot be soundly analogized to that of the holder of an annuity, whose right to benefits is bottomed on his contractual premium payments. Let me translate that from legal jargon. Your Social Security contributions are not a contract. They're not an annuity. You have no legal property right to a single dollar of benefits. Congress can change the rules, cut your benefits, raise your retirement age, or eliminate the program entirely at any time. FICA stands for Federal Insurance Contributions Act, but the Supreme Court ruled it is not insurance in any legal sense. So there's no savings account, there's no legal right to benefits, and the ratio of workers to retirees has collapsed 98% since 1940. Let's look at why the math broke and why it's about to get much worse.
For decades, the Social Security math worked, not because the system was well designed, but because of demographics. In 1940, there were 159 workers for every single retiree, 159 people paying in for every one person taking out. With those numbers, you can pay Ida Mae Fullers all day long. The math is easy. But watch what happens. 1940, 159.4. 1945, 41.9. 1960, 5.1. 1980, 3.2. 2010, 2.9. 2024, 2.7. 2040 projected, approximately 2.1. From 159 to 2.7, that's a 98% collapse in the funding base, and it's still falling. A Ponzi scheme survives only as long as new money flows in faster than old money flows out. The Social Security Ponzi is running out of new money. But why did it happen? Two forces created this death spiral. Force number one: we stopped having children. At the peak of the baby boom in 1957, the average American woman had 3.6 children. Today, 1.6. In 2024, the US fertility rate hit an all-time record low. Replacement level, the number needed just to maintain population, is 2.1. We are 24% below replacement. Forget growing the worker base, we can't even replace the workers we have. Force number two: we started living much longer, which is great unless you're running a pension system. In 1940, a 65-year-old man could expect to live another 12.7 years. Today, 18 to 19 years. That's 50% more years of collecting benefits, while fewer and fewer workers pay in. And now comes the knockout punch. The baby boomers are retiring. Between 2024 and 2027, 11,200 Americans are turning 65 every single day. That's 4.1 million new retirees per year. This is the largest surge of retirements in American history, and there aren't enough young workers to pay for it. Now here's what most Americans still believe. There's trillions of dollars saved up in something called the Social Security Trust Fund, a lockbox protecting their benefits. This is the most successful piece of financial propaganda in American history. The Social Security Trust Fund, $2.7 trillion, sitting in a vault somewhere, ready to pay your benefits. That's what most people believe. But here's the question nobody asks. If there's really $2.7 trillion sitting in a vault somewhere, why does Social Security run a deficit every year? If the money is saved, why do projections show insolvency in 2033? Let's look at what the trust fund actually contains. There is no vault. There is no cash. There is no lockbox. There is a filing cabinet in Parkersburg, West Virginia. Inside that filing cabinet are paper certificates called Special Issue Treasury Securities, non-marketable bonds that can't be sold to anyone, just IOUs. In 2005, President George W. Bush visited Parkersburg and saw the trust fund with his own eyes. A lot of people in America think there's a trust, in this sense, that we take your money through payroll taxes and then we hold it for you, and then when you retire, we give it back to you. But that's not the way it works. There is no trust fund, just IOUs that I saw firsthand. The office here in Parkersburg stores those IOUs. They're stacked in a filing cabinet. Imagine,
The retirement security for future generations is sitting in a filing cabinet. A Republican president telling you the trust fund is a filing cabinet full of IOUs. So how does this actually work?
Here's what happens to your payroll taxes. Step 1. Treasury collects your FICA taxes. Step 2. That cash goes immediately into the general fund. Step 3. That cash is spent on whatever Congress wants. Wars, programs, tax cuts, doesn't matter. Step 4. Treasury writes an IOU to the trust fund. Step 5. The trust fund now holds a promise, not money. Don't take my word for it. Here's what the Clinton administration wrote in its fiscal year 2000 budget, buried in the fine print. These balances are available to finance future benefit payments, but only in a bookkeeping sense. They do not consist of real economic assets that can be drawn down in the future to fund benefits. Instead, they are claims on the Treasury that, when redeemed, will have to be financed by raising taxes, borrowing from the public, or reducing benefits or other expenditures. Read that again. They do not consist of real economic assets. The Obama administration's Office of Management and Budget said the same thing. While the federal government will certainly make good on the IOUs issued to these trust funds, they should not be counted when assessing the financial state of the federal government as a whole. Here's the truly insane part. That $2.7 trillion in IOUs appears on the federal books as both an asset to Social Security and a liability to the Treasury. When you consolidate the government's books, they cancel out to zero. The trust fund is an accounting fiction.
So where did the money actually go? From 1983 to 2020, the Social Security system collected nearly $2.9 trillion more than it paid out in benefits. That surplus was supposed to be saved for the baby boomers' retirement. Instead, every single penny was borrowed by the Treasury and spent. Wars, tax cuts, domestic programs. It didn't matter what, they spent it all. They left a filing cabinet full of IOUs and called it a trust fund. The propaganda says, your money is safe in the trust fund. The ledger says, they spent your money and left a note promising your kids would pay it back. Now, calling Social Security a Ponzi scheme might sound like partisan rhetoric, inflammatory language from people with an agenda. But here's the thing. 3 Nobel Prize-winning economists, spanning the entire political spectrum, have used those exact words. Let's start on the left. Paul Samuelson won the Nobel Prize in Economics in 1970. He was a Keynesian, a liberal, and one of the most influential economists of the 20th century. In 1967, he wrote this: "The beauty of social insurance is that it is actuarially unsound. Everyone who reaches retirement age is given benefit privileges that far exceed anything he has paid in, exceed his payments by more than 10 times. A growing nation is the greatest Ponzi game ever contrived." Samuelson wasn't criticizing the system, he was praising it, calling it a Ponzi game that works, because the population was growing. The problem? The population stopped growing. Now let's go to the right. Milton Friedman won the Nobel Prize in 1976. He was a conservative, a free market champion, and the intellectual father of modern libertarian economics. In 1999, he wrote an article titled "The Biggest Ponzi Scheme on Earth." The assurance that workers will receive benefits when they retire does not depend on any trust fund. It depends solely on the expectation that future Congresses will honor promises, what supporters call a compact between the generations, and opponents call a Ponzi scheme. Friedman added something Samuelson missed. Whereas Ponzi had to rely on suckers, the government can and does use force. You can't opt out, it's mandatory. Now let's go back to the left. Paul Krugman won the Nobel Prize in 2008. He's a progressive, a New York Times columnist, and no friend of conservative economics. But in 1996, before he became a political commentator, even Krugman wrote this: "Social Security is structured from the point of view of the recipients as if it were an ordinary retirement plan. But it's nothing of the sort. The system turned out to be strongly redistributionist, but only because of its Ponzi game aspect, in which each generation takes more out than it put in. Well, the Ponzi game will soon be over, thanks to changing demographics. The Ponzi game will soon be over. He wrote that in 1996, 30 years ago. A Keynesian, a free market conservative, a progressive. All three looked at the math and reached the same conclusion. This isn't politics, it's arithmetic. So we know it's a Ponzi scheme. We know the trust fund is empty. We know the demographics have collapsed. The question is, when does it end? The answer isn't a prediction. It's a date on a calendar. According to the 2025 Social Security Trustees Report, published by the Social Security Administration itself, the OASI Trust Fund will be depleted in 2033. 2033. That's 8 years away. If you're 30 today, you'll be 38. If you're 50 today, you'll be 58, still years away from collecting a single check. And this isn't a prediction from some think tank with an agenda. This is the official projection from the people who run the program. So what happens when the trust fund hits zero? By law, Social Security can only pay out what it collects in payroll taxes that year. No borrowing, no bailouts from general revenue, just whatever comes in. The result? An immediate, automatic, across-the-board benefit cut. 23%. No congressional vote, no debate, just math. The average Social Security benefit today is about $2,000 per month. A 23% cut means losing $460 every month. For a typical retired couple, that's over $11,000 per year. Gone. For the 40% of seniors who rely solely on Social Security for income, this isn't an inconvenience. It's a catastrophe. And it gets worse. By the end of the 75-year projection window, benefits will cover only 69% of what's promised. That's a 31% permanent cut. The longer we wait to act, the deeper the cuts become. 2033 is when the checks get smaller. But here's the question that should make every young worker furious. Who's actually paying for this system right now? And what are you getting in return? Remember Ida Mae Fuller? 924 times return on her money. Early participants in Social Security hit the jackpot. What about today's workers? The Social Security Administration's own actuaries calculated the implicit rate of return by birth year. Born 1920, plus 2.82%. Born 1943, plus 1.82%. Born 1964, plus 1.88%. Born 1985, plus 1.07% for medium earners, but negative 0.50% for maximum earners. Born 1997, plus 1.06% for medium earners, negative 0.52% for maximum earners. If you were born before 1943, you did okay. If you're a millennial or Gen Z, you're getting barely above 1% real return if you're a medium earner. But here's the real kicker. For maximum earners, people who paid the most into the system, the return is actually negative. Negative. You would literally be better off stuffing cash in your mattress. But the real theft isn't just the negative return, it's what that money could have become. What if you could have invested your Social Security taxes yourself? Crystal Bull ran the numbers for a median income worker who worked from 1975 to 2024. If their FICA taxes had been invested in an S&P 500 index fund instead of Social Security. Social Security benefit, approximately $1,883 per month. S&P 500 account at retirement, $3.725 million. Monthly withdrawal from that account at 5% interest, without touching the principal, $15,523 per month. If you drew it down over your life expectancy, $30,880 per month. $1,883 from Social Security. $30,880 if you'd invested it yourself. That's 16 times more. 16 times. But let's say you're risk-averse. You would never invest in stocks. Even if you put every dollar in boring, safe treasury bonds, you'd still have $4,400 per month at retirement. That's more than double what Social Security pays. Social Security isn't just a bad investment. It's the worst investment you're legally required to make.
This isn't a conspiracy theory. The people at the top know exactly what's happening. Here's Larry Fink, CEO of BlackRock, the largest asset manager in the world, in his 2024 letter to shareholders. It's no wonder that younger generations, millennials and Gen Z, are so economically anxious. They believe that my generation, the baby boomers, has focused on its own financial well-being to the detriment of those who come after. And in the case of retirement, they're right. They're right. The CEO of BlackRock, admitting the theft. The national debt is $38 trillion. Social Security's unfunded liabilities, the gap between what's been promised and what can be paid, is $66 trillion on an infinite horizon. Combined, over $100 trillion in obligations. Divide that by the number of American workers, and you get roughly $600,000 to $750,000 per worker. That is the mortgage on your future earnings that you never agreed to sign. When pollsters ask how to fix Social Security, the answers split cleanly by age. 89% of seniors 65 and older want younger workers to pay higher taxes. 53% of under 30s prefer cutting benefits for current retirees. Seniors want to keep getting paid. Young people want to stop being robbed. And here's the brutal truth about democracy. Seniors vote at nearly double the rate of young people. So young workers are getting fleeced. The math is obvious. The unfairness is undeniable. Why doesn't anyone fix it? Because of one brutal fact about democracy and demographics. In 1982, an aide to House Speaker Tip O'Neill coined a phrase that has dominated American politics ever since. Social Security is the third rail of American politics. Touch it, and you die. And he was right. In 2005, President George W. Bush made Social Security reform his top domestic priority. He launched a nationwide tour. He visited Parkersburg. He saw the filing cabinet. He made it personal. The result? The more he talked about reform, the more public support dropped. Public disapproval rose from 48% to 64% in just 5 months. The plan never even received a vote in Congress. Why? Because AARP, the American Association of Retired Persons, has 38 million members. That's larger than the population of Canada. In 2025, when the Social Security Administration announced service cuts, AARP mobilized 2 million emails to Congress within 2 weeks. The cuts were reversed. AARP has been called the 800-pound gorilla of American lobbying. They don't lose. Here's the brutal truth about democracy and demographics. Voter turnout, ages 18 to 24, 47.7%. Voter turnout, ages 65 and older, 74.7%. Seniors vote at 1.5 times the rate of young people, and they vote to protect their benefits. A politician who cuts benefits loses the next election. A politician who does nothing lets the math cut benefits in 2033, when they're safely out of office. Every politician who promises to protect Social Security without proposing reform is actually promising a 23% benefit cut in 2033. Doing nothing is the cut. But it doesn't feel that way until the checks get smaller. So, reform is impossible. Politicians won't act. The math is inevitable. What does collapse actually look like? We don't have to imagine. We have examples. Social Security isn't just one piece of retirement income for most Americans. It's the piece. 40% of seniors rely solely on Social Security for income. 50% get at least half their income from it. 25% get 90% or more of their income from it. For these people, a 23% cut isn't a haircut. It's falling off a cliff. Without Social Security, 37% of American seniors would fall below the poverty line. With it, only 10% are.
A 23% benefit cut could push nearly 1 million additional seniors into poverty. We don't have to imagine what pension collapse looks like. We have examples. Detroit, 2013. The city declared the largest municipal bankruptcy in American history, $18 billion in debt. Retirees saw benefits cut, healthcare eliminated, cost of living adjustments zeroed out. Central States Pension Fund. This fund covered 350,000 Teamsters. It proposed cuts of up to 60% before requiring a $36 billion federal bailout, the largest pension bailout in American history. Puerto Rico, 2024. The island's employee retirement system was completely exhausted. Average pension, $12,708 per year. The island filed for $120 billion in bankruptcy. These aren't hypotheticals. These are Americans whose retirements were destroyed. And here's something most people don't consider. Every dollar of Social Security benefits spent supports roughly $2 of economic activity: groceries, pharmacies, small businesses, local economies that depend on retirees' spending. A 19% cut would shrink that economic impact by over 16%. That's hundreds of billions pulled from local economies across America. At this point, it might feel hopeless. The system is broken. Reform is politically impossible. Collapse is inevitable. But that's not quite true. Other countries faced the same demographic math and fixed it.
Let's be clear about what we're not saying. We're not saying there's an easy fix. We're not saying reform is painless. But the argument that nothing can be done is simply false. Other countries faced the same demographic death spiral. They acted, and their systems work. Sweden. Sweden saw the crisis coming in the 1990s and acted before it was too late. They created a notional defined contribution system with one critical feature: an automatic balancing mechanism. If the system's assets fall below its liabilities, benefits automatically adjust downward. No political vote required, no can to kick down the road, just math. 5 of Sweden's 7 major parties supported the reform, representing over 80% of voters. Left and right agreed. This was math, not politics. Australia. Australia went further. They require employers to contribute 12% of every worker's salary into a private retirement account, called superannuation. Result? $4.5 trillion in real assets. Not IOUs, not promises. Real money in real accounts with real names on them. Australia is the only OECD country where pension costs are projected to decrease as a share of GDP. Workers own their accounts, the money is real, and it can't be raided by politicians. Singapore. Singapore's Central Provident Fund requires contributions of up to 37% of wages, split between employer and employee. 2025 Mercer Global Pension Index ranking, 5th in the world. Top system in Asia, first A grade ever awarded to any country. The result? 90% home ownership, genuine retirement security, and no reliance on future taxpayers. All 3 systems share key features: real assets, not IOUs, automatic adjustment mechanisms, so politicians can't kick the can, clear contribution to benefit links, you know what you're getting, bipartisan support. Reform happened because leaders agreed it was math, not politics. The United States has none of these features, and we've had 30 years of warnings. The 2025 Trustees Report states that the problem has been evident for almost 3 decades. We simply chose not to act. Sweden, Australia, Singapore. They looked at the same math and acted. The United States looked at the same math and did nothing. So what does all this mean for you? Let's bring this back to you. Every paycheck you receive, 12.4% is taken for Social Security. 6.2% comes directly from your wages. Another 6.2% comes from your employer, money that would otherwise be part of your compensation. Over a 40-year career at median income, that's roughly $400,000 in today's dollars. $400,000. That money does not go into an account with your name on it. It goes to pay current retirees. And when you retire, you will depend on future workers to pay you. Workers who haven't been born yet.
who didn't agree to this deal, who will inherit over $100 trillion in obligations. If you're under 50, you're looking at a 1% real return, assuming the system doesn't cut benefits. If you're a higher earner, your return is actually negative. Meanwhile, that same money in a simple index fund would have made you a millionaire several times over. You didn't choose this investment, you can't opt out of it, and you can't get your money back. So let's do a final accounting. The propaganda says, Social Security is your retirement savings. The ledger says, you are paying a 12.4% tax to fund a government-managed wealth transfer from young to old. The propaganda says, the trust fund will protect your benefits. The ledger says, the trust fund is a filing cabinet of IOUs in West Virginia. The propaganda says, politicians will fix it. The ledger says, every year of inaction makes the eventual cut deeper. The propaganda says, you have a right to your benefits. The ledger says, the Supreme Court ruled you have no legal property right to a single dollar. 3 Nobel economists called it a Ponzi scheme. The Supreme Court says you have no legal right to benefits. The trustees say insolvency hits in 2033. Reform is the third rail of politics. No one will touch it. The only rational response is to assume Social Security will not be there for you in any meaningful form. Plan as if you'll get 75% of what's promised. If you're pleasantly surprised, great. If you're not, you won't be blindsided. This video wasn't meant to make you angry, although you probably are. It was meant to show you the truth so you can plan accordingly. Because here's the thing about the truth. It doesn't change based on whether you know it. Social Security will hit that wall in 2033, whether you watch this video or not. The difference is, now you know. And knowing gives you something most Americans don't have. Time. Time to save more. Time to invest more. Time to build something that actually belongs to you. Your financial future is in your hands, not in a filing cabinet, not in a politician's promise, in your hands. Now I want to hear from you. Drop your prediction in the comments. Do you think Social Security gets reformed before 2033, or do we hit the wall and let the math do the cutting? And if you want to stay ahead of the next economic time bomb, because trust me, Social Security isn't the only one, hit subscribe. We break down the numbers most people don't want you to see.